Hey everyone, welcome back to Property Finance with Lee and part 4 of our Ultimate First Home Buyer's Guide series. In this video, we're going to tackle an expensive hurdle to the purchase of your first home, LMI. If you're new to the channel, don't forget to subscribe and turn on notifications. We cover all things property financing and investing, so you have the information you need to achieve your property goals. Let's start. Let's start by understanding what LMI is. LMI, which stands for Lender's Mortgage Insurance, is a form of insurance designed to protect the lender, not the borrower, in the event of a default. It comes into play when a borrower's deposit for a property is less than 20%, and therefore the loan amount required represents a higher than 80% loan-to-value ratio, or LVR. In such cases, the lender faces a higher risk if the borrower defaults on the loan, as there is less equity to cover potential losses. LMI serves as a safeguard for the lender by covering a portion of their potential losses in the event of a default. This insurance enables lenders to offer loans with smaller down payments, making home ownership more accessible to borrowers with limited savings. Okay, that all sounds fair enough. Why should I care? Well, you, the borrower, must pay for it. And the costs are substantial. Going back to an example that we used during our video on grants, if you're looking to purchase an existing property in New South Wales valued at $600,000, however only have a 5% deposit of $30,000, you would be out of pocket around $24,000 according to Westpac's LMI calculator. The question I'm sure some of you are asking right now is, can I avoid paying LMI? The answer is, well, perhaps. There are several ways in which you can avoid paying LMI. The simplest way is to save for a 20% deposit. Okay Lee, obvious, how else? A couple of weeks ago in part 2 of our guide, we discussed grants which can be used to remove the need for LMI. There are 3 different types of grants available: the First Home Guarantee, the Regional First Home Buyer Guarantee, and the Family Home Guarantee. If you're interested in knowing more about them, go back to part 2 where I discuss them in detail. The truth is, more than likely, you probably won't need to worry about paying LMI the next time you are after a loan, because there will be enough equity built up in your property to put your lending amount below 80% LVR. The question is, can you use the equity built up in somebody else's property, let's say for example your parents' home, as a guarantee? Yes. If your parents are agreeable to this, lenders will allow their property to be used as security in the event of a default. As part of the process, your parents will need to seek independent legal advice about what the risks are to them and their property in the event of a default, and show evidence of this to the lender. Furthermore, they will need to be interviewed separately to the borrower to confirm this arrangement and their understanding. Now, some of you may not be aware of this, but certain professions are also eligible for LMI waivers with certain lenders, namely accountants and doctors. You're required to hold membership in certain industry bodies and, depending on the lender, have certain levels of income. The eligibility criteria for this is quite strict. It's best to contact me from the details below and I can point you in the right direction. These packages might allow you to borrow even more with a smaller deposit without paying LMI. So if you're a doctor or an accountant, it's worth inquiring about. There are lenders out there that will also provide you with varying degrees of LMI exemptions if you're a partner in one of the following companies. Typically large accounting or legal firms. There is a lesser known but potentially game-changing strategy for a lot of people out there, which is forming a shared equity agreement, or SEA. While SEAs are not common, they present a valuable opportunity to provide both a smaller deposit and avoid LMI. Here's how it works. You find an SEA provider which you can enter into an agreement with. The SEA provider can put up most of the deposit, although most SEA providers will require you to put down at least 5% yourself. You now have your 20% deposit, avoiding LMI as you are within the 80% LVR. So what's the catch? You pay interest on the amount provided by the SEA, and the term typically expires around 2 to 3 years, at which time you will have to refinance, which shouldn't be a problem as you have been paying your mortgage and the property's value has also increased in that time. Is that it? No. This is called the shared equity agreement for a reason. Once refinanced, you will also have to pay capital gains proportionate to the amount provided by the SEA. So as an example, if you receive 15% towards the deposit of your home and at the end of the SEA term your property went up $100,000, you would be required to pay $15,000 to the SEA provider, along with their initial funding amount. The costs associated with this are steep, but it can allow you to enter the market much quicker with a smaller deposit and avoid paying LMI if you're unsuccessful in getting a grant. Alright, so we know what LMI is, how expensive it can be, and how we can potentially mitigate it. I know some of you may still be wondering whether it is worth just saving for a bigger deposit. For your own peace of mind, I want to run you guys through some math. Imagine you're purchasing a home in Queensland worth 600k. You have the money set aside for stamp duty and your other costs, however, you only have a 10% deposit. As we know, that requires LMI to be paid. According to Westpac's LMI calculator, that will cost you $22,835. The question as to whether LMI is worth paying for you is simple. We know that major cities in Australia historically experience average price growth of around 7% year on year. Let's say it would take you a further 2 years to save the remaining 10% of the deposit to avoid paying LMI. If we look at 600k increased by 7% year on year for 2 years, we end up with a property value of $686,940. Assuming an interest-only loan for simplicity's sake and an interest rate of 6% on the outstanding loan amount of $540k, the interest amount paid in the 2 years is $64,800. Now we can grab the amount of capital gain of $86,940 and interest can see that we are ahead $22,140. How much was our LMI again? $22,835. And we have $22,140 after interest over that period. What this tells us is, in this example, if it takes you less than 2 years to save the deposit, you may be better off waiting. If it will take you longer than the 2 years to save your deposit, you're probably better off paying LMI, as a capital return will outweigh the cost of LMI. Guys, I cannot stress this enough. This is just an example. You can plug in your own numbers and do the math as to whether it's worth it for your situation. LMI costs vary from lender to lender, interest rates are not set in stone, and there are years where the market outperforms the average of a 7% increase. In conclusion, the choice between a lower deposit and a 20% deposit hinges on your financial circumstances, objectives, and risk tolerance. If you found this video helpful, please give it a thumbs up and don't forget to subscribe for the next part of the series. If you're seeking expert guidance in your property financing, don't hesitate to reach out through the link provided in the description below. Thank you for joining us today. Catch you next time.